Hi, this is Ron Parks and welcome back to the channel. Today I have a longer video. I want to talk about 13 investment mistakes that retirees make. And if you can change just a few of these in your investment philosophy and your investing habits, you'll be wealthier at the end. So let's just get right into it. Okay, let's get started. Mistake number 1, placing big bets. Few people would go to Las Vegas, put a significant portion of their entire life savings on the table, and make one roll of the dice. While the reward for winning that bet might be huge, the probability of winning simply isn't worth the risk of losing and the pain that it could bring. Yet time and time again, investors do just this, albeit not in such a dramatic fashion. The most common big bet often isn't viewed as a bet. That bet holds a large portion of your investment savings in your employer's stock. Sure, you might feel loyal to the company and think its prospects are good, but that may mean making investment decisions based upon emotion, which is likely not the best move. So here are just 2 examples. You remember Enron, which had revenues of over $100 billion and had been named by Fortune as America's most innovative company for 6 years in a row? Well, it went out of business when its massive scandal unfolded in 2001. Investors and employees saw the stock plummet virtually overnight. Hardly anyone saw this coming. And do you remember Tyco? Well, employees saw their stock go from $117 to $25 during the Dennis Kozlowski CEO scandal from November 2001 to July 2002. And there are many other examples of companies suddenly losing a large percentage of their value. So don't fall into that trap. Diversify your portfolio. It's smart and relatively easy. Now, a more dramatic big bet that could be costly is investing a large portion of your retirement portfolio based on a hot tip or an initial public offering you think might take off. This is a risk for many reasons. First, if you know something, others likely know it as well, and therefore the stock market has already incorporated it into its stock price. And second, an investment that is being pitched as a sure thing could be a scam. And third, you can simply just be wrong. A big bet can be tempting, especially if you feel you might need to catch up on your retirement savings, or if the person giving you the tip is someone you respect. But that is really mixing emotions and investing decisions, because a potential recipe for headache and regret is to invest on emotion. Okay, mistake number 2, being too conservative while you invest. Now, conservative investing may not be as safe and prudent as it sounds. For example, many investors associate bonds with safety. In the short term, bonds have been less volatile than stocks. But you might be surprised to learn that over a longer time horizon, let's say 30 years or more, stocks have had a lower volatility and more consistent and higher returns than bonds. Now, stocks have outperformed bonds every single 30-year period since reliable data has become available. Bonds have many risks. One is that their value can fall dramatically if interest rates go up. Bond prices and interest rates have an inverse relationship. As interest rates increase, the value of the bonds decrease. And for example, if you need access to your bond investments to pay for a wedding, help an adult child, make a down payment on a home, deal with unanticipated home or medical expenses, or if you want access to cash now, you could be faced with selling a bond below the price you paid for it. With interest rates near historic lows, but on the rise, do you believe interest rates are more likely to go up or down in the next few years? If you think it is going to go up, you've just proven to yourself that bonds are not as low risk or as conservative as they appear to be. Cash and certificate of deposits are also conservative investments that might not be in your long-term best interest, as they typically yield too little to be appropriate for long-term goals. We now come to mistake number 3, falling for a PONZI scheme. We need to say only 2 words about PONZI schemes. Bernie Madoff. Now, Madoff masterminded one of the largest financial frauds in history. cheating the wealthy, charities, and everyone else he could. One of the reasons he got away with it for so long was that his firm was both the money manager and the custodian of the funds. His firm controlled the supposed investments he was making. Now, there's nothing wrong with that. It's called a managed account, and it's what most wealth managers do as well. However, many money management firms don't take actual custody of the funds or the assets that they buy, but they use highly respected third-party firms like brokerages or large banks. That means the custodian maintains control of your investment assets, independent of your advisor. This helps protect you from fraud. So while not all money management firms that take custody of your funds are crooked, virtually all Ponzi schemes rely on controlling possession of your funds. So do yourself a big favor today, right now. If your investments are managed by anyone other than yourself, make sure you know who your custodian is and that they are an independent, distinct, and separate entity from your money manager, whose control is limited to making investment decisions. Now, that is often the case with brokers who use their firm as the custodian. Just be sure it's an arm's length transaction, an arm's length separation. Having a custodian won't prevent your money manager from making blunders or mistakes, but it will restrict the money manager's ability to make transfers and loot your account. Okay, let's talk about mistake number 4, paying excessive fees. Now, many retirees, well, they do pay excessive fees, sometimes without even being aware of it, and it makes it less likely that they can achieve their long-term financial goals. Fees can cost you hundreds of thousands of dollars over your lifetime. The investment fees impact you in 2 ways. First, the actual out-of-pocket expenses and charges, and secondly, the money unnecessarily spent on fees loses the power of compounding returns, or what we know as compound interest, which can add up to significant amounts over a lifetime of investing. Now, even seemingly minor differences in fees can make a massive difference in the amount of money you end up with. Now, for example, let's assume you invest $1 million in 2 mutual funds over 20 years without taking any distributions. And let's assume, well, this is a really high assumption, that they have an average annual return of 10%. Now, we're using this just to make the numbers easy. Now, one has an annual fee and expenses of 1.5%, and the other one has an annual fee and expense of 2.4%. So the exhibit below will show you that all things being equal, except fees, the one with the lower fees will put you over $800,000 more in your pocket over time. And considering how hard you have worked for your money, paying high fees really doesn't make sense. Okay, mistake number 5, ignoring the insidious effects of inflation. The U.S. is in a long period of high inflation, with prices rising above 7% annually. You need to worry about inflation and its effect on your portfolio. First, your personal inflation rate might be much higher than the average inflation rate. So let's say you have a spouse who requires long-term care, and you have 3 grandchildren who will be starting college over the next few years. You've promised to pay their tuition and fees. And because the cost of these services has risen much faster than other goods and services in the economy, these expenses could have an outsized impact on your retirement nest egg. And secondly, even a slight increase in inflation, barely perceptible in your week-to-week or month-to-month spending, can make a huge difference in your spending power over time. Let's take a look at Exhibit 2, which assumes a 3% inflation rate, which was the target rate for the Fed prior to having this rampant inflation increase. After 10 years at 3%, what used to cost you $50,000 will now cost you nearly $67,000. That is a whopping 34% increase to maintain the same purchasing power. And that's with a low inflation rate. Historically, we have seen inflation rates far exceeding 3%. You may recall in 1979, 1980, and 1981, the annual inflation rates were 11.3, 13.5, and 10.3%. We now see this kind of inflation happening in the U.S., and many economists are concerned with the high inflation rate. So whether inflation becomes a dramatic problem or simply an ongoing, steady erosion of your purchasing power, you should prepare so your retirement investments can keep up with increases in the cost of living. A conservative fixed income investment strategy may result in lower than expected growth rates, putting your long-term retirement goals at risk. Also, people sometimes find that they actually spend more money in retirement than they did while working. You've heard so much about, well, you'll spend less money in retirement. Well, traveling, fixing up the house, owning a second home, and helping adult children and grandkids are all terrific, but they can quickly drive up expenses and lower your portfolio. So let's move on to number 6, relying on common knowledge. There's much widely accepted information and countless experts eager to share their opinions confidentially when it comes to investing. I advise you to cultivate a healthy skepticism and remember that the market rarely does what most believe it will do. Investing adages aren't always true. One of the oldest and most enduring investment adages is that your asset allocation should be based on your age. And as you get older, you should own more fixed income investments. For example, if you're 60, it tells you to have 60% of your portfolio in bonds, such as treasuries, and 40% in stocks. At 70, your ratio should be 70% bonds and 30% stock. But there's a big problem with this. If you're 60 years old today, you are highly likely to live for another 25 years. Your spouse may live even longer. And over that period, you may need more growth from your portfolio than fixed income investments can provide. So by following conventional advice of owning more bonds as you age, well, you might shortchange your retirement lifestyle, or even worse, putting it at risk by increasing the probability that you'll run out of money. So that simple formula isn't suitable for everyone because not all 60-year-olds are the same. You might be a vigorous 60-year-old with a family history of longevity, or you might have a severe heart condition and parents and grandparents who died in their 50s and 60s. Following the herd mentality right off the cliff. Following the crowd is not a recipe for investing success. Stocks move in anticipation of events, and if everyone has the same information that has you excited, the advantage is pretty much gone. It's already discounted in the market or priced into the market. So you're probably too late to the party, and one of the biggest reasons individual investors generally do worse than the market averages is because they tend to follow the herd, buying when the market is nearing its peak and panic selling when it's down. So keep all of that in mind. Now, mistake 7 is something that everyone has a problem with, and everyone tries, or some people try, but most people fail. And that is trying to time the market. So trying to time the market perfectly is, well, almost impossible. And mistakes can be costly because corrections or market drops of 10% or 20% come without warning, and the recovery that follows can be just as fast. Now, corrections are sentiment-based and can change rapidly. It's so hard for investment professionals to time the market. I believe it is prudent for a long-term investor to be in the market unless you have strong reasons, unclouded by emotion and bias, to think a bear market is underway. Now, bear markets where the market is down 20% or more generally come on slowly and rarely announce themselves. Significantly, bear markets are based on fundamentals. Consistently identifying a bear market early on, let alone predicting one before it starts, is also extremely difficult. Now, let's suppose you miss calling a bear market and your portfolio is down 20% or more. It is often wiser to stay in the market rather than sell at a significant loss, as the market usually rebounds dramatically when a new bull market begins. So take a look at Exhibit 3, which shows the market from 1927 to 2019. It shows that the market is up and down, but it's up big in the long term. And that is the important point. There's lots of up and downs, but the trend is really clear. For the patient long-term investor, the stock market has offered strong average annual returns of around 10%. The long-term returns for those trying to time the market are likely much lower, because in the short term, markets are quite unpredictable. So I suggest being patient and disciplined so that you can take advantage of the long-term earnings power of the stock market. Now, patience is a blessing if you can follow the rule to sit quiet and let the market take you to higher territory. Okay, mistake number 8, buying gold or other commodities. Now, investors often turn to gold and other commodities during times of volatility and uncertainty, especially in the stock market. Many, if not most, gold purveyors use fear and scare tactics to get you to buy their product. They tend to talk or write about imminent global financial collapse, how the world order is going to crumble, how the stock market might fall so far that your portfolio will become virtually worthless, or about how inflation can skyrocket and wipe out all of your paper wealth. That's why they say you need to own gold. It's pitched as a safe investment for a troubled world. There are several problems with this. First, while the world is facing many problems and challenges, consider what we have dealt with. World War II, the rise and fall of communism, almost continuous war and tensions in the Middle East, 9/11, the rise of terrorism, the Great Recession of 2008, the emergence of China as a leading economic and military power, the Russian war with Ukraine. Well, the list just goes on. And what has happened to the stock market? Well, it's continued to rise over all these time periods. Although it's true gold has had several periods of very strong performance, these periods are very hard to predict. And in between, gold has tended not to be a very good investment. So overall, gold has not been nearly as good as an investment as the stock. Since 1973, the average annual return of stocks has been around 10.5%, while gold has been at 6.1%. Now, this difference might not sound like much of a big deal, but consider the impact over the many years. So the cumulative return of gold has been around 1,400%, while stocks have cumulatively returned over 10,000%. And if you take a look at the chart, it will show you what gold, bonds, and the S&P 500 have done over the years. I think it's a good benchmark to take a look at and to remember. So don't rush into commodities, because they probably will not get you what you could get from investing in the stock market. Okay, so I want to make sure you don't get discouraged, me listing all of these mistakes of investing prior to retirement. But I think if you can come away with a few of these mistakes and adjust your way of investing, it will have a great benefit on your portfolio in the long term. So let's move on to number 9, buying annuities. Now, many investors either currently own or are seriously considering annuities. Annuities are often sold as, well, as safe investments, offering dependable and predictable returns, no matter what the market does. The promise of guaranteed income can be very appealing, especially after suffering through a bear market, recession, or just the daily fear-mongering and sensationalism of the financial press and the cable news. So what is the problem with annuities? Well, many annuities are complicated insurance policies with lots of small print, conditions and riders that make it very, very difficult to fully understand how they work and what that means for you. And more importantly, once you buy an annuity, it can be extremely difficult and potentially very costly to reverse your decision. So here's why I think annuities are not a prudent investment for most people, especially those with portfolios over $500,000. Okay, number 1 is liquidity. If your needs change, your annuity doesn't. You may be locked into the annuity unless you're willing to pay high surrender fees to cancel it. And number 2, taxes. You might be faced with higher taxes because many annuities are taxed at ordinary income tax rates and not the lower long-term capital gains rates. Okay, number 3, returns. A promised return might not be so simple. Your annuity might contain a clause that allows the insurance company to reset your rate of return. Plus, the rate you are quoted might be before fees and expenses. That's why you need to carefully read and study the contract. Typically a long, complicated document. Number 4, fees and charges. Well, annuities generally come with a multitude of fees and expenses. These fees come out of your principal and out of your pocket. Annuities have some of the highest fees of any investment product. And even though you might have a guaranteed return of, let's say, 5 or 6%, most of those fees can eat up at least half of those gains. Okay, number 5, inflation. Some fixed annuities really don't offer protection against inflation. So the spending power of your income from an annuity will decrease. Over a 20-year period, a 3% inflation rate will erode the value of your payment by almost half. So $1,000 a month today will be like $550 in spending power 20 years from now. And remember, a guaranteed income stream is not the same as a guaranteed spending power stream. Okay, number 6, survivor benefits. Make sure you understand the terms of the annuity should you pass away. Some annuities may not provide the coverage you assume and that your spouse may need going forward. So I'm pretty much very, very pessimistic about annuities. And if you are thinking about an annuity, you really need to talk to an expert that only deals with annuities as a financial product. Okay, let's go to mistake number 10. Mismanaging your retirement withdrawals. Now, you've done everything right so far. You've invested properly. You've built up a really big nest egg. But many investors have trouble switching from saving to spending. So given my experience working with thousands of people who are close to retirement or are retired, I've learned that deciding how to generate income and how much to spend in retirement is often stressful, complicated, and confusing. So even if you have accumulated a large nest egg, making the wrong withdrawals could put your retirement at risk. So generating retirement income requires you to balance a variety of elements, many of them beyond your control, such as inflation, stock market volatility, interest rate trends, and you and your spouse's expected longevity. If you are too conservative in your investments, you risk having inflation strip you of purchasing power. If you're too aggressive, you risk losing your money. Taking too much out early in your retirement, you risk running out of money in your later years. And if you're too stingy with your withdrawals, you might be cheating yourself out of enjoying experiences that your hard-earned money could enable you to do. So these are difficult and emotionally charged decisions, and investors frequently make mistakes or act irrationally. Now, given the stock market's long-term returns, which have averaged around 10% a year, a common mistake is assuming you can withdraw 10% out a year for the rest of your life. But that might be a recipe for disaster, because the market doesn't move in a straight line. For example, if the market turns bearish and drops 20%, and you still withdraw 10%, you would need a 39% gain just to get back to the initial value. A couple of years of large withdrawals during down markets, and you could find yourself in a very bad position, which, well, it might be impossible to recover from. I also see the opposite mistake. Some investors take too little because they're afraid to touch their principal. And it's perfectly fine to reduce your principal, provided you have a large enough retirement nest egg to last your entire life. The other reason to touch your principal is that, well, your investment goals don't require it. Perhaps you don't want to leave money to any person or organization, or maybe you simply want to live it up and spend everything you have until your last day. Well, like so many things, the key is to know yourself and your goals and find a balance of what feels right while protecting your downside if things go bad. While rules of thumb don't really take into account your unique situation, most people should plan on withdrawing no more than 5% from their portfolio each year. And strategically planning your withdrawals can be complicated. That's why an investment firm offers clients advice and tactics to manage withdrawals. that are prudent, tax savvy, and can help increase your peace of mind. If you're ready to start taking money out of your retirement account, I would really talk to your investment advisor. And if you don't have an investment advisor, I would find one. Take a look at your portfolio and come up with a plan of how much and when you should do withdrawals. So a lot of investors, they ignore international stocks. And that's mistake number 11. The United States is the world's leading economy. And many of our largest companies are major global players. For example, multinational companies headquartered in the U.S. often get a substantial portion of their revenue from sales outside the U.S. So it might seem that you can get the functional equivalent of major diversification in international stocks by buying certain U.S. stocks. But this isn't the case. On average, stocks tend to behave like other stocks from their home country, regardless of exposure to international revenue sources. As the next chart shows, U.S. stocks and non-U.S. stocks tend to change leadership positions often and irregularly. So from 1970 to 2019, non-U.S. stocks actually perform better slightly more of the time. And that raises another question. Why not just buy American stocks if you're a long-term investor and not prone to emotional buying and panic selling? After all, the chart shows both do equally well over time. And the reason to diversify into non-U.S. stocks is simple. I believe it can help reduce the volatility of your portfolio's return over time. U.S. stocks might lead for years and years, or it might lag for years and years. No one knows what will happen next. But by owning U.S. and non-U.S. stocks, you hedge your bets and smooth out your returns. The United States makes up roughly 64% of the developed world's equity markets. But you could overweight your portfolio to a bit more than that percentage in U.S. stocks if you have good reason to believe that the U.S. market will outperform non-U.S. stocks. And if you have a fundamental reason to believe that non-U.S. stocks are going to be better, then do the opposite. If you're correct, you'll get a small performance bonus. And if you're wrong, you won't have hurt yourself too badly. In either case, you would have reduced your overall risk through global diversification. And I think that's a very, very important thing to do. So I'm not sure if you've heard the saying that politics invades every portion of your life. So mistake number 12 is letting political beliefs drive investment decisions. Although this can be very difficult and means going against your gut, it's wise to remain politically and ideologically agnostic when it comes to investing decisions. If you are politically conservative, you're likely to believe that when the Democrats are in power, the country's stock market and economy are likely to do worse. If you're politically liberal, you're likely to believe the opposite. In fact, the stock market can do well regardless of whether Democrats or Republicans are in power. Political ideology is just another form of bias that colors your thinking, making you blind to some things and exaggerating others. That's why making investment decisions just because you like or dislike the party in power could cost you a lot of money. Remember, your political beliefs matter, but not in terms of your investing. When you actually look at the data, the results are very clear. Neither party is significantly better or worse for the stock market, but that doesn't mean that politics doesn't drive much of the market, especially in the short term. For example, nearly everyone believes Republican leaders are more pro-business than Democrats. So when a Republican is elected president, the stock market almost always has a great year, averaging a 17.9% increase. But then a perverse thing happens. The new Republican president doesn't do or can't do what he promised, and the stock market reacts just the opposite, with the market averaging a return of 2.6% during the inaugural year. As the next chart will show you, the inverse is true when we elect the Democrat as president. The election year averages negative returns of 2.7%. And the inauguration year averages a whopping 22.1% increase. So don't let your political views take control of your investing decisions. Okay, so I've saved the best for the last. And this is my 13th mistake that a lot of investors make. Trying but failing to diversify. There's something called false diversification. That's when you think you are diversifying, but you really aren't. And perhaps the most common false diversification occurs among mutual fund investors. Many think that because they own 5, 6, or more mutual funds, well, they're well diversified. But all too often they have bought mutual funds that are similar in their investing style and stock selection. And why the result is that while they have multiple investments, they all rise and fall in the same pattern. That's not diversification. That's inefficiency. Real diversification increases your investable opportunity and helps reduce volatility in the long term. Diversification is easiest to achieve when you have a more expensive portfolio. I would say above $500,000 or more in investable assets. At this level of assets, purchasing individual securities to build a global diversified portfolio makes sense, and it becomes easier to build a portfolio tailored to meet your unique goals and objectives. So I've gone through 13 mistakes that you potentially could make on building your portfolio for retirement. I would say if you can walk away with 3 or 4 of these and adjust your investment style, taking into account that a lot of these issues that I brought up are easily correctable, then I think you're on the way to greater wealth and more security towards your retirement. I appreciate you watching. If you have any questions, please leave a comment below, and I look forward to the next time. And thanks.